We're bringing out the charts for a technical view of the markets. We're calling this a special edition of Technical Tuesday. It's because special is how often do you hear someone say, I love bonds, I don't like stocks? Well, that's the view of our next guest. Joining us from New York is Parets. He's president of Eagle Bay Capital and editor of the technical analysis blog allstarcharts.com. Good morning, JC. Nice to see you.
Thanks for having me, Francis. How are you?
I'm good, thank you. One of my producers wants me to know, are you feeling okay, this whole bond liking thing?
Yeah, I mean, listen, we look at a lot of sentiment data, and obviously, you know, price itself is the only thing that pays, but everybody hates it, Francis, and not only is the sentiment extremely pessimistic in the bond market, but the price action itself is making its way higher, and rates are dropping, and nobody wants to talk about it. I love that.
We're going to take a look at a chart that you provided for us. You call it a false breakout on the yield side of things. Tell us what this chart tells you about this false breakout and what it means in terms of how low yields can go.
Sure. Well, here we're looking at the 10-year yield, which is essentially the benchmark for U.S. interest rates. And that 3% level is where we peaked earlier in the year, in the fall, late summer. And going into the holiday season, we were creeping above, 3%. When nobody was paying attention, nobody's at their desk, creeping above it. Sure enough, we come into the new year, and it failed miserably, and rates have been dropping throughout the entire year. And I think that speaks volumes. And the fact that everybody hates bonds, everyone's convinced rates are going higher, it's starting to do the opposite. Nobody wants to talk about it. I think bonds are still a buy.
So a buy, but buy for a 2.5% yield or a 1.5% yield?
Well, I think the first stop is down to those lows. So you're looking at about 2.5, sure. And then after that, realistically, I think we got a good shot to see 2.1, 2.15 on the 10-year. Wouldn't surprise me one bit.
Gosh, that's going to upset a lot of the shorts because they've been big-time short, or they've been positioning short on the bond side. The flip of the
But they've made a lot of money already, Francis. They've made a lot of money. Bonds are down over 20%. I mean, come on.
Well, they want to make more. You know that. It's all about greed in the end. But let's put that bond call in the context of an equity call. Most people are saying, stick with the program, stay long equities. It might be more stock picking, but you're a little worried here. Well, I think we've got a chart of the S&P 500.
Well, I'll give you that. I do think that it's more of a stock picker's market. I think that it's been more of a stock picker's market even throughout last year. With the S&Ps making new highs, less and less stocks were in uptrends. Less stocks were making new highs. So I think we've already been in more and more of a stock picker's market. I think that's going to continue to be the case. But in terms of the S&P 500 itself, I've been saying it all year. I think it's a fade up here. I would not be buying it. I don't think it's worth the risk. But to your point, there are some individual equities out there that you can buy. Just the averages alone, I don't feel comfortable initiating positions up here.
JC, I want to look at this chart again with our viewers. And you've got some numbers on here, including one number at the top of the chart, which I think is 261.8%. Strikes me as that's a Fibonacci number. And you've done some very specific calculations here. Am I right that that's a Fibonacci number? And what does that mean in terms of where we can pull back to?
Sure. Well, when we're at all-time highs and we're essentially in uncharted territory, there isn't former support and resistance for us to look at. There's no supply and demand history up here. So for us technicians, it becomes harder, and we have to we have to find our measured moves. So the last correction that we saw in the S&P 500, I mean real correction, was in 2011. We saw what? It was a 21% decline, 21.5%, something like that. The 261% extension from that particular correction, the last one that we had, takes us right here to the recent highs, right around 1850. In addition to that, we have like a major rising wedge in the S&P 500 where not only when we have uptrends do we connect all of the troughs, all of the lows, but we also connect the peaks as well. And sure enough, that also takes us right here. So when you have those combination of things, and we're frothy up here, obviously, I would rather be a seller than a buyer. I just don't feel comfortable initiating position up here with this much resistance.
Now, I've been mentioning more than a few times the TSX is outperforming the S&P 500 so far this year, just by a little bit. We're still in positive territory as an index, but overall as an index, you're not all that positive on Canadian equities either.
No, not a fan of equities as a group. Like I said, individual names, sure. But Francis, last time I was on in October, you and I talked about the TSX relative to the S&P 500. In other words, Canadian stocks compared to U.S. stocks. And I still think that they have a chance to outperform. I mentioned that 7.8 in the ratio between TSX and SPX. We still haven't taken that out. We're right around 7.5. But once that ratio gets taken out to the upside, that could be a signal that Canadian stocks are set to outperform going forward.
But you're not really pound the table on any stocks right at the moment.
On an absolute basis, no.
No, on the indice level. Let's talk about natural gas, because we always like to get your views on it. Been a great trade, a lot of winter weather, a lot of cold. That's certainly helping. Where do you stand on nat gas right now?
Nothing's changed. Status quo. I still think we go higher. We've seen some nice pullbacks. The pullbacks get bought. We broke some major resistance in the last couple of months of the year. We retested that successfully last week. I thought that was impressive. And I think we go higher, Francis. I think, we're looking at $5 as the initial target, which has been resistance over the last few years. So I think that's the first level where we can hit. And then eventually, I think that we can see 6.25 in natural gas prices, which takes us back to those 2009 highs from that rally, as well as a major Fibonacci retracement, 38.2% from the 08 to 2011 crash.
Now, gold,
big level.
I believe the last time we talked, you were not buying gold. I think you're calling it now a hot mess in the short term. What's that mean?
Well, it's been a hot mess. I mean, long shorts, a lot of frustration in that market, and fortunately for us, we've kind of shied away from it. So I think with gold, it really depends on what your time frame is. So we got to take a step back and ask ourselves, what are goals? And in terms of gold, I think in the short term, this rally can probably continue. Maybe another 75, 100 points in gold. I'd be a seller in the mid-1300s, 1350 or so, because structurally, it's still a mess. It still has work to do. I still think it finds its way lower. That $1,000, 1050, has really been staring at us for a while. I've been looking at that, but in the short term, right here, right now, I think there's probably a little bit more of upside before you can fade it.
And everybody I know or listened to here over the past couple of weeks hates our dollar, the Canadian dollar. What do you think?
I look at the USDCAD, right? So dollar-Canadian dollar ratio, and this is a major base. Francis, these patterns are few and far between when you have 4 or 5 year bases, and we're breaking out of that. So that stands for dollar strength, relative to Canadian dollars. So you're looking at probably another 7% downside in Canadian dollars, which would take the USD-CAD up towards about 116 or so.
Okay, we're just looking at that dollar, our dollar, right now. Thanks very much, JC. Always good to catch up.
Yeah, thanks for having me, Francis. Have a good one.
You too. JC Parets, president of Eagle Bay Capital and editor of allcharts.com. He joined us from New York.